right. Well, it is 10 o'clock, so let's go ahead and get started. Thank you so much for everyone who is logging on this morning and joining us for this week's Coffee with Chris. This week is going to be a very simple and short and easy talk, but it is very, very important. And we suspect that for a lot of your clients, it's going to have some very significant implications. So before I jump in, I want to let everyone know that we are hosting an event next week on June 10th. So it's going to be on a Friday. So, who has better things to do on a Friday than to come to a motivational event? And it's going to be from 12 to 2 o'clock. We're bringing in lunch and we encourage all of you to sign up for it. The gentleman's name is Rene Rodriguez. Our bank is sponsoring him, which means that you guys get to come for free and the bank's paying a lot of money for it, which is what we all like, right? But he's going to be teaching us on how to amplify our influence in today's world where everything is grabbing people's attention. It's going to be really good. Chris and I were able to see the first half of his talk, and it was pretty impactful. So we're excited about it. If you want some more information on how to sign up, just shoot one of us a message, or when I post this later on, go ahead and leave a comment on there and we'll get you connected to that. So that's my little shameless plug for this morning. I want to open up by introducing Chris here. Most of you probably know him, but if you don't, he is the branch manager and regional vice president at Novus Home Mortgage. He's been in the industry for 25 years, and his partner and wife has also been in well over 20 years. And so they've got a combined 48, 49, something like that, years of experience together in the mortgage industry. So Chris, you've seen a lot. And you have a lot of expertise and knowledge of this area of credit, consumer credit, that we're going to be talking about today. So thanks for taking the time.
Well, thank you, Mindy, and thank you for all of you that are joining or watching the video after when it's saved. We appreciate you joining. Today, the topic is, not just about credit, but what's coming down the line as of July 1st. There's some big news, some big announcements that will help maybe some of your clients that had some collections that were hanging on, dropping their scores to a level to where they couldn't qualify for a loan. And right now, what they're talking about is dropping some medical debts that people might have. So some great news on the horizon for those who might have these pesky. What I see over the 20-something years, it's not these hefty medical bills. It's really not. It's typically people didn't pay a deductible or something. And some of these hospitals, they just don't do a good job of getting in touch with people, and they just attach it to the credit report. And then you have a collection for $150 or $200, $300. And it's minor. It's a minor amount. And I'm not discounting $500 to people, but where it is a huge impact is on your credit score. So for something for $200 that you probably would have paid immediately if you knew it was there, just hung on and then through the process, now you have this little hurdle that you have to overcome and in some cases disagree with. And I would encourage people, if you have a $150 medical bill, don't dispute it. If you think the insurance should have paid for it, if it's going to get in the way of you buying your forever home or your home, sometimes in some cases, just easy to pay it off. So that being said, if you're, go ahead.
What was announced? So the three major credit agencies, they're Experian. I'm not really good at remembering them, but Experian,
Equifax, TransUnion.
Yeah, so they all came together. So this wasn't really a government regulation per se, but it was these three major credit agencies came together and decided that they're having a change in policy. What is that change of policy?
Well, first off, before I get into that, 1 out of 10 Americans are burdened with this medical debt, and I think it's more than that from what I see. And then nationwide, don't quote me on this, but I believe that the total medical debt is around $18 billion. That's 18 with a B, billion dollars. So that's a big number, which means it's affecting a lot of people, which over the past has been affecting their credit. So if there's a collection on there, you can imagine 1 out of 10 at least is affected by this. So what the three major credit agencies, what they're saying is that they've announced that they're going to make some major changes. So as of July 1st, 3 of these changes are going to be medical debt that hasn't been paid or has been paid will no longer be included on credit reports. So if you had a medical debt that was paid and it still sits there as paid or was on there, they're going to eliminate that, which will help your score. So if you had debt on the record, it's going to disappear, which is a great thing. So which will increase that score automatically. You're going to see an increase. So if you're following Credit Karma or you're on Experian, after July 1st, if you may not even know, you may not have even pulled your credit, you might see a spike in your score. Just know maybe there was a collection on there that was on there that now was falling off. The second thing is they're increasing the amount of time before medical debt in collections would appear on your credit report. So the cushion is now at 6 months, but they're going to lengthen that to a year. So if you had this collection that just kind of maybe in the last 3 months or 4 months kind of came on, well, it'll be 6 months right now at the current stage, but it'll be lengthened out to a year, which would give you time to hopefully get a notification of some kind from them, even if they're behind before it would get to that point. So that would give you some extra time to work with your providers or the collectors to find some kind of a mutual agreement and a payment solution.
Well, and that's also huge for those people who do have significant medical debt, say from a surgery or an accident or something like that. Giving an extra 6 months, so extending that to a year, gives them more time to pay it off or come to a payment solution before it ever even goes on your credit history at all. So that is, I know most people, it's a small amount, but for those who are burdened by serious medical debt, that's a huge, huge change.
Correct. And then the beginning half of the first half of 2023, all 3 consumer credit reporting agencies, TransUnion, Equifax, and Experian, will no longer include medical debt in the collections under a $500 limit on the credit report. So if it was just like 1 or 2 co-pays that you didn't get in or something minor, that you just didn't, in most cases, didn't even know was there, you thought your insurance was paying for it, it's not even gonna come up as an issue. I mean, of course, they will still try to collect their money from you. It's just not going to affect your credit score. And I do always say, pay your bills, pay your debt. It's always the right thing to do. So that's the top 3 things. So I'm going to summarize these real quick. Medical debts that have been paid are no longer going to report at all on the credit. They'll disappear. That will increase your score. 2, they're increasing the time that medical collections appear on the bill on the credit from 6 months to a year. And 3rd, first half of 2023, all 3 reporting agencies are going to be looking at anything under $500 will not be reported. So those are 3 huge things. So if you have some buyers that may have there might be just something that you just mentioned to them. Hey, good news. Did you hear the stuff that, the changes that are happening on the credit on collections? You don't need to be an expert. You just, at least you look like you're on top of it. So what we want to do is just feed you little arrows in your quiver that you can throw out there. You don't need to be an expert in it, but it's a good talking point. Hey, by the way, I was on this, webinar, whatever you want to call it. I sat through and listened to this. I don't want to call myself an expert. It just sounds good if you say it. So I'm not by any way, shape, or form that any of you guys out there claiming to be an expert, but it sounds good if you say that. And they were saying how these changes are coming down the pike. So one of the questions that I know that we're going to have is, how does this affect buying a home, right, Mindy? So that's one of the things. And I don't know if I can hear you, Mindy. I don't know if that's my.
Sorry, no, I muted myself.
Okay.
That's what I was just going to ask is, so in terms of how this relates to buying a home and home mortgages and such, so obviously getting that dropped off their credit score and increasing the credit score has a lot of impact. So with buying a car, credit cards, all that good stuff. But in terms of buying a home specifically, what does this mean for new potential buyers? And what does this mean to people who maybe couldn't qualify before because of this? Can you walk us through that?
Yeah, so I definitely think, if you had some clients that maybe didn't get the amount that they were looking for. Maybe there was some debt to income issues. Maybe there were some collection, maybe not. It would be a good time for one to reach out to those folks. If you have a few people that you were working with that didn't qualify due to credit, and it will just give you an opportunity to talk to them again. It may not be, their issue may not have been medical bills. It could have been, but it may not have been. But it's, again, another touch point, and it just shows, and you're adding more value because, their credit score could have been down based on this collection, and it took them 2-3 months to get that score to rebound and get back up after they paid it off. So just a good talking point to reach out to them because they may not have qualified, and just touch base with them and separate yourself as a professional and an expert in your field, because some of the stuff that's coming on. I just want to share my screen with you guys because there's a couple things I think that are really important. Let's see here if I can find this, just to talk about credit, just so you have a better understanding on some of the stuff here. Let me see if you guys will see this when I pull it up. Oops. I may have some. Do you guys see that? Do you see that, Mindy? You do not see that. Okay. Let's try that again. For some reason, I'm not seeing it. I just wanted to kind of walk through, and if I can't pull it up, I can still kind of walk you through it. Regardless, for some reason, it's not coming up in my queue to share. Let me see if I can close out and try it again one last time so we don't run it out of time.
So while you're looking that up, I can share a quick story of what I bet that this looks like for a lot of people, that they wouldn't think about it. So when I was like, I don't know, 21 or something, I went to the doctor. It had a copay that was mailed to me after the fact. I mean, we're talking, it was like $15. I had moved before, like right before they mailed me that copay. So I never got the bill for it. So years later, I come to find out that this $15 copay was in collections, and I had no idea about it for years. And of course I, took care of it then and made a bunch of calls and everything. But I think that's what we need to think about, is people like that who, for no reason at all, or something that could have been a total fluke or mistake, and it's dragging their reports and their scores down because of something stupid like that. I mean, I was one of them. Like, I pay my bills every time, and I just had no idea. All right, Chris, we can see this.
Oh, you can see it. Okay.
Yep.
So just here's a good chart just to educate yourselves on how credit really works and what it looks like. In the past, I've had a lot of clients that would reach out to me, and they would talk about, oh, I pay my bills every month. I just pay them off. But if you look at some of the things on how your credit is being scored, the obvious one, as you see in the pie chart here, 35% is based on your payment history, meaning you make your payments on time. That's the obvious one. That's the one that we all know and we all think of. Hey, if you're late, it's going to hit your score. These other things, though, have a major impact on that score that most people aren't really aware that how much that it affects the score. So for example, the next block that you see there is 30% of your score. That's a third of your score is based on the debt and available credit. So let me give you an example. If you're the guy that pays your card off every month and you max it out every month, let's just say you have a $1,000 limit and you use it for all your groceries, your gas and everything, and it crawls up to about $800, and then you pay it off and it's at zero again. You do that over and over. What happens is the way that it's reported is it's a screenshot in time. So let's just say, for example, your credit card was open on the 5th of the month and they report on the 4th. And at that time, your bill is due on the 5th and you just made your payment on the 3rd. You're not 30 days late. You're just a day out. They take a snapshot of time, and that card is now, you're being scored based on that $800 debt, which then has a 30% negative impact because you're maxed out on that score. So I always encourage my clients, I encourage my partners, if you have these little weird conversations with people, you say, hey, listen, if they're friends of yours and like, oh yeah, I get all my points, you're just talking the small talk. You should always be like, listen, make sure you pay that down. It could affect your possibility of buying because it will have a negative impact on it if it reports it with the balance. So balances are huge. You don't want to have it maxed out. The optimal place to be is under 30% of utilization. So for example, if you have $1,000 limit, you want to keep that card balance under $300 or less at all times. And you don't want to have it at zero. Believe it or not, if it's at zero, when they take that snapshot in time, it doesn't give any measurement in some cases. So it just looks like you don't use it. You have credit, but you don't use it. So they're not looking like you're actively using the credit. So I know it's strange. I run simulators for people all the time, and sometimes I got to put debt on a card to get their score up. I don't need you to be experts in it. I just need you to focus on 30% of your score is based on your debt and your available credit. That's a big one that most people miss. The third thing is 15%. How long have you had your credit? A lot of people will get the 0% card in the mail for a year or two, and then they'll go and pay off 4 or 5 of their cards they may have had for 10 or 15 years or 5 years or whatever. They had it for a long time. 15% of your score is a pretty big chunk of your score. We can all agree on that, right? It's a little less than 1/4%. So if you closed out 2 cards because you got the 0% card, your score is going to have a 15% negative impact on your score. So for example, if you have that 740 score, that's going to give you perfect credit, the perfect rate and all that good stuff that comes along with having good scores, and you do something like this and it drops your score down to a 715, well, now you just got bumped down. Or if you were a 720 and now it bumps your score to under 700, you now get hit with a higher rate because of something you thought was good. So remember, if you've had a card for a long time, keep the card open. Unless it's a horrible card and it's, the interest is crazy high. But especially if you're buying a house, I would not close that card until you were done doing whatever you wanted to do. So that's a big key. And then the third and fourth, right? The fourth and fifth, I guess, would be what types of credit you have. You want to have a mixed bag. If you have like 20 revolving accounts and that's it, it will have a negative impact on your score. You want to have a balance of credit, right? So you might want to have a couple installment loans, maybe 1 or 2 for cars, 3 or 4 credit cards, and maybe a mortgage. That's going to be a very mixed bag, but still 10% is a difference of a 710 score to a 695 score, so to say, right? And then the frequency is what you always hear is, listen, if you pull my credit, well, how bad is it going to affect my score? Well, frequency and credit applications, whenever anyone's buying a house, now, I'm going to be very clear on this. I want you all to understand it. We got about 1 minute left. I'm not talking about when you're shopping for a mortgage. I'm talking about when you're shopping for a mortgage and you're opening up the Kohl's card and you're opening up the TJ Maxx card because you're going to get 15% off and you're in the process of buying a house. Well, each time you have someone run your credit to pull it to open up this new account, it's going to have a negative effect on it. So, for example, you're an FHA buyer, you need a 600 score, and you're at a 605 and you just open up a TJ Maxx card, could be the difference of not being able to qualify for that loan. Same as getting the better rate with a conventional loan, right? If you just start opening up. Now you have 30 days to shop for a mortgage. You can have multiple companies pull your credit. So that is not going to affect you while you're in that window of shopping for a home. And there's a window for cars. I think it's 2 weeks that you can go shop for cars, but mortgages, you got a month. So you can have multiple mortgage companies pull your credit and that's fine. However, that 10% will affect you if you're opening up other cards, gas card or this card or that card, because you want to get the discount. If you're in the process of buying a house, it could be detrimental on a payment, could make a difference of 20, 30, 50 bucks a month in payment by doing something like that.
Hey, Chris,
So, yes.
someone who's tuning in just texted me a question.
Okay.
So I wanted to real quick throw this out there. They said, can you go over again what the ideal mixed bag of types of credits is?
The ideal mixed, if you had, so say you have a car loan or 1 or 2 installment loans, most basic homes, they have 1 or 2 car loans, right? That's an installment debt. And a mixed bag of credit cards. Maybe you have 4 or 5, $10,000 credit limits in there. You don't want to have like 20 credit cards because it's not an evenly distributed mix of credit, right? And then you might have a mortgage. So you want to just always try to keep that a manageable thing. Because if you have, for example, if you have 20 credit cards open or 15 credit cards open. It looks like you could be robbing Peter to pay Paul all the time, or there could be some that you're just not using and they're at zero. So they're really not helping your score at all. If anything, it could be hurting your score because they're not even being utilized. So, you know, if you have a lot of dead weight on cards that you're not using, you might want to drop them and then kind of reset for the 2 months, but try to keep an even surplus of credit, right? So you have 4, maybe 5 cards, revolving card debts, 1 or 2 installment debts, and then your mortgage.
Would like a car be included as a good one if you have a car loan?
Yeah, that would be a good one. That's an installment loan. So any kind of installment loan is something with a fixed payment. So a car payment you have for 3 years or 5 years. You might have 1 or 2. If you're married, you might have 2. Or you might have a car and a jet ski, or a car and a motorcycle. That's even. Now, if you had 4 or 5 cars on there, it may not be ideal for you, right? It may kind of have a 15% negative impact. Maybe you're buying cars for everyone in your house, right? And it's all on your credit. And everything else is good. It doesn't say you're going to have horrible credit, but it will have a 15% impact on your score if it's not an evenly balanced portfolio, if you will, on what you have.
You know, Chris, I think one of these upcoming Coffee and Chris's, we should talk solely on just credit and how to get it up, because every time you talk about it, we always get a ton of questions. I think it's one of those areas that like is veiled, and it's such a mystery to people. So maybe we'll keep that in mind for a future Coffee with Chris, because I think there's so much more here.
And if guys, any realtors on here, guys, girls, ladies, gentlemen, anyone on here, we love to do virtual lunch and learns where we can take 30 minutes, whether live in person, if you want us to come to your office, and we could give us a list of topics that you really want to have a better understanding on. We won't take up more of your time, but this call, really, we want to try to keep it to, 15 to 20 minutes. We're at 22. You can always call me, message me. We'll set up a time. We'll do either a Zoom or we use Teams here at the office. I can kind of walk you through a bunch of different things. We really want to educate you. I want to take this time to arm you and prepare you to be different and separate you from the competition that you're working out there. So want to say thank you for all that joined. And if you do have more questions that we didn't answer in this call, just message Mindy, message myself, and like our page. Sign up virtually for the event next Friday. It's going to be called Amplify Your Influence. He's one of the, Rene Rodriguez is one of the experts in this field. He coaches with Grant Cardone all over the world. He's one of the authorities in this area. So please message us so we can get you out the invite. You can do it in person at the RASM building in Sarasota. That's the Board of Realtors here in Sarasota off of Cattleman. I'm going to provide lunch from 11:30 to 2. It's from 12 to 2 on the 10th. Sign up because I only have a limited amount of tickets. They're $300 a piece. Our bank is paying for, but again, this is going to be a game changer for those of you who have listings, who are meeting with buyer clients. It's going to be how to position yourself as an authority and amplify your influence. I mean, because right now, this is what the name of the game is. When you're getting in front of somebody, you get one shot. So if you're interested in that event, guys, message us. We'll get you out the ticket, whether you're going to do it at your comfort of your office or your home, or if you want to come to the live event. I do have some limited tickets available for you.
Well, thanks so much, Chris. Thank you for everyone tuning in. We will be here next week, same time, same place.
Yes. Looking forward to it, guys.
Goodbye, everyone.
Thank you.